Good day, fellow investors. Today we're going to talk about very exciting stocks that you probably never heard about. But this is investing, this is for me investing, and in this video I really wanted to show you 12 different stocks that will give you a perspective on what's out there, what is investing, what are the risks and rewards, and the main drivers for many stock prices, so that you can see at the end what is it that you want to own as a business owner, because that defines you as an investor and your long-term investing returns. And these ideas, these 12 stocks, were given to me by you when we discussed another similar stock that many of you never heard about, Jungfrau, the cableway bringing you up into the Swiss mountains. So similar stocks today, and then you see what best fits for you. If you enjoy this really in-depth stock analysis on boring stocks, please click that like button and consider subscribing, because that's what I do for a living. I look at very boring investments, which makes my life boring, but I can do it for you so you then don't have it. And that's what I do. Let's start. So what are we going to look for? A strong business with a moat, nobody coming in tomorrow taking the profits away, good fundamentals, no structural risks. I want a company that will survive no matter what, makes me sleep well, a fair price, happy to get a good return now, and even better in the future, because it is a strong business with a moat, and it has to be rewarding shareholders through dividends, growth cycles, economic cycles, whatever. But this is, let's say, a quartet of things that I'm looking when it comes to investing. The first stock we're going to talk about is A2 Milk Company, traded in New Zealand, and the company makes A2 milk. There are cows that make A1 milk that's, they say, not healthy for us, and A2 milk that they make, and they sell 65% of that in China. So we can say emerging market, Chinese growth stock, really exploded since 2015, was that a 20 bagger, was even more, and now declined because the growth slows down. And this perfectly explains what happens when investing in growth stocks if the growth estimations are not met. But now it often turns into a value stock, price earnings ratio of 21. So let's see a little bit more about this stock. So as we said, with A2 Milk, total revenue is 1.73 New Zealand dollars, has been growing fast, but the outlook is now for single-digit growth. And when you see single-digit growth, and the reason is higher competitions, because they started making money, but at the end it's just milk. So cows, there is no competitive advantage in cow milk, no matter how you brand it or formulate it. So that's the issue now. And for me, there is no moat. Yes, they have strong supply chains and everything, but simply too risky for a price earnings ratio of 20. The next stage of growth is based on just branding. It's all about marketing, or however they want to play it, and if people want A2 milk compared to A1 milk. They're now trying to grow in the US, but sales have been just 60 million despite the distribution growth over time. We are still at 60 million compared to 1.7 billion in total revenues. So yes, they are trying, they will do whatever they can do, so it all depends on the future growth. We see here how they have expanded their operating margins from much lower margins when they were a normal milk company, I think, in New Zealand, and of course net income expanded also, but now this is expected to be slower. The three key investing concepts here to learn from are slowing down growth, competition coming in, and if it is the one with the moat, then there is plenty of time. Like it has been the case for Microsoft Corporation, that even if you bought it 7-8 years after the IPO, you would still have made 100 times your money, not including the dividend. Also with Coca-Cola, the growth was stagnating from 1920 to 1924, and I bet a lot of analysts were saying how Coca-Cola is dead. Of course, since then it returned 14% per year, so turned $40 into 16 million. But the outlook is what is pushing the stock price down. So revenue, single-digit growth, higher competition, and they have to see how they are going to grow faster. If not, the stock will keep declining. I have made a quick earnings per share valuation table. Depending on the growth rate, I get to an intrinsic value of 6 if they grow slowly. If they manage to grow 10% over the next 10 years, then the stock price is a little bit undervalued at now 11 compared to 14. If their growth rate stagnates, they start to lose profit margins. If they start to see declining profit margins that are very high, as they are a milk company and competition is now going in because everyone wants A2 milk in China and we in Europe have all A2 milk, so it's not really a moat, which makes it risky. Too much risk, let's say, for me even to watch this, and that's a very difficult industry, the milk industry. Another company that in this case has a moat is Corticiera Amorim, traded in Portugal and Europe, and it makes the corks for the very expensive wine you're going to drink. And look at this. This stock has gone from €1 in 2010-11 to, what is this, 10-12 euros in 2017. Huge growth, and since then it has been stagnating. Of course, they are producing what they are producing, corks. They are planting new trees to produce the corks, but this is the key. So over time, here in 2010, the price was €1 and the earnings per share were 16 cents, 20 cents. So the stock was trading at the price earnings ratio of 5. Of course, it was Europe, it was Portugal issues, so here and there you can find price to earnings ratio 5 for companies with a moat. This company has a moat because to plant these trees it takes simply so much time. And then the market gets exuberant, it sees increase in net income, triple, but it increases the stock price to a 10x. Now it's, let's say, a fairly or overpriced company. The next crisis in Europe or in Portugal, and you see trouble again. Another company that's very interesting, Algonquin Power and Utilities, is another different stock. This time we don't have a moat, but they are focused on cash flow earnings and dividend growth. Everything grows. They own sustainable electric producing transmission assets, and they are growing very fast. And look at this, they have grown revenue almost 10 times in 10 years, but they have done it by quintupling the number of shares outstanding. They're using expensive equity to grow. And there are many companies like that, so they're going to invest 9 billion into new capital expenditures, new investments into renewables and whatever, but my question is, who is going to consume all of this? We already have energy. Do we really need so much more with so much new companies doing it all for us? If you look at the stock price, of course, it's going nothing but up. But for me, there is simply too much risk that a company like this keeps growing forever, because at some point in time, this equity issuance and things like that, this financial engineering, is about to end. And then it will get very, very ugly. I'm not saying Enron because that was fraud or not, but this is something really baking on the current trend, nothing more. After all, it's just utilities. Another company, Aryza, I get an email every few months about it. Okay, Sven, what do you think about this stock? This is a baker from Switzerland that goes bankrupt every few years, and it's simply a bet on the company turnaround, but it's just so much debt there that this is too much betting for me. Everybody's looking at the stock price. Yes, what happens if I pay now 0.82 and it goes back to 200? That's 200 times my money. Yes, that's the bet. Will they make it? I have no idea, because if I look at the numbers, the debt is there and they are losing 700 million per year, and the net debt is 1 billion euros. That's really, really crazy. Too much risk for me. Another similar to Jungfrau Bahn, BVZ Holding, railroads in Switzerland. Railroads in Switzerland, good numbers, everything looks good, new projects, they are investing in real estate, also building some new apartments in Switzerland. That's always valuable. But if I look at the balance sheet, I look at the long-term liabilities, it's simply too much for me. Okay, 50% of assets, but those assets are inflated. So again, too much liabilities for me there. Compagnie des Alpes, 10 mountain resorts, 13 leisure parks. They are doing this, Wabibi in the Netherlands, don't know how it's called. I look at the fundamentals, revenue growth, okay, 50% growth over the years. Book value not even increasing that much. They are paying a dividend in good times, but for me there is so much of it and high capital requirements, competition, prices depending on the European economy, etc., etc. Too much risk and no moat, I would say. Another great company, Straumann, that did really well, 10x over the last 7 years. So Swiss company, of course. And again, look at the revenue. The revenue just doubled over the last years. Earnings per share also just doubled. But given low interest rates, everyone is crazy about such companies that increase dividends, not even double the dividend, but the sentiment in the market changed. And now, from a bad situation, we are now at a great exuberant situation. The dividend yield just 0.55%. Shows the exuberance in the market. Everybody's chasing protection, so too much risk for me. This protection is actually risky. Another company, Getlink, that owns the tunnel that goes from France to UK and other properties, but this is just like a bond. Free cash flows are pretty stable, and then again, nothing that it will grow or it has something special. So again, not a company for me. EVN stock, stable again, a stable utility. You can read my analysis, Sven Carlin, EVN AG stock. You write it in Google and you'll see what I wrote when the stock was cheaper by 25%, somewhere in what it was June 2030, as I'm analyzing the complete Austrian market. So again, a utility, but nothing special. Okay, good business, good dividend, but that's about it for me. Then a very amazing company, Games Workshop, that makes these figurines and has these games where people play around that I would never invest. But if we look at the stock price, this is actually a 20 bagger for a friend of mine. He has invested here heavily and now he's sitting on 20 bagger returns. Really amazing what the company did. And then again, if you look at revenue, okay, they have tripled revenue from here after a period of very bad growth. So the stock was actually down here, and they have tripled revenue, quadrupled net income or even more, and the stock went out to up 20 times. Now we can say it's too expensive. If they can replicate what they did on the growth side here in the UK globally, then this can again be a 20 bagger, but I simply can't find myself investing in this. If you're a user, you can feel the company better, and perhaps it will be the next 10 bagger for you. Especially look how they expand into new markets. They have definitely a moat because I don't think there are many producers of these figurines and these games. Another interesting company, Société Anonyme Banques Étrangères or whatever. I would call this the Bitcoin of the rich. You can own part of Monte Carlo, you can enjoy, you can buy the luxury properties, you can own the casinos there, you can own beautiful restaurants in Monte Carlo, you can own hotels, whatever, party. So if you want to own what the Grimaldis own, what the really rich people in the world own, you can get that by owning these properties in Casino Square, Monte Carlo, the casino, the park, the hotels, whatever they own, and other properties. So really insane what you can all own. The restaurants, hotel, Hermitage, shopping areas. So really interesting. But the only problem is it's not really that profitable. They have done huge capital investments, but the owners are the royals there, and they are practically not interested in dividends or in maximizing earnings there. They made plenty of money on other ways there, it seems. So the question is, when are you going to reward shareholders through profits? And earnings, negative, positive, but not big, and they didn't pay really dividends. So it's more of, okay, I own this and that's it. So not really shareholder focused, unfortunately. A company that's more shareholder focused, there you own Monte Carlo, here you own Paris. So a lot of properties in Paris, mostly business but also residential. So if you want to own, what is this, half of Paris in the 8th and the 1st and the 2nd and 9th arrondissement, how do they say, then this is the company for you. The dividend yield is 4.5%. Don't forget another thing, the French dividend tax here. But it's an interesting, let's say, a REIT, European REIT, if you want to own something like this. Because when it comes to REIT, there are three factors: rental income that leads to dividend, growth in the investments that they are making, which they are making, and inflation. So if there is inflation in corporate real estate, then you might see also higher and higher dividends. So we'll talk more about REITs. There are some interesting REITs, but you have to see how these REITs fit your requirements. It's about dividends, reinvesting dividends, and owning a piece of Paris or a piece of Monte Carlo. They are building, for example, they have a 5.5 estimated yield on cost, which is good, especially when you leverage it. So a typical REIT. However, real estate markets and rates are the main risk. If the real estate market in Europe, and keep in mind the demographics are bad, if the real estate market tanks, it will not be good, especially because they are constantly changing things. They are selling the hospitals, they are selling this, they are buying other things. So they are really not focused on business growth as much as loans. They have made an acquisition, now they're lowering the loan to value ratio, but these values are again estimations. The key value is the flow of funds and the dividend. Also keep in mind the dividend tax, and they are constantly going to change and try to extract as much value through the pipeline and the portfolio's rotation. I don't know why they are doing that, because they have to justify their existence. So 12 stocks, but this is investing. At the end, Charlie Munger says you only need 3 great investments in your lifetime to make it worth it. And that's what we are looking for, but you need to turn a lot of stones to get there, and that's what I do. And if you manage to come to the end of this video, then you are a real investor, then you can tap yourself on the back, because this is investing. Boring, ugly, boring, but the boring you're looking at, the easier it will be to find something really, really great, and then make a deep analysis on that. Buy it and forget about it. Enjoy your life while the business makes your returns. Thanks for watching. Click that like button. Let me know in the comments if you made it till the end. I'll see you in the next video.